Let's check in on oil. The price around $74 US today, but so far in 2023, crude is down around 8%. Actually, oil closer to $73 right now. Our guest thinks that OPEC Plus will extend production cuts right through the summer of 2024, but it does face 5 years of struggle in keeping oil prices up. We are joined by Robert McNally, president of Rapidan Energy Group, formerly an advisor at the White House. It's always great to talk to you. Thanks very much, Robert.
Hi, Andy. Thank you for having me on.
I want to get into your thoughts on peak oil shortly, but just to keep it for 5 years, you think OPEC Plus will have its work cut out to keep oil prices up?
It does, and it will, Andy. But there is a pot of gold at the end of that rainbow. Our 10-year outlook, Rapidan's recently updated 10-year oil outlook, concludes that even if we see aggressive electric vehicle penetration around the world, we did several scenarios, even if EVs run wild, we still have a tightening oil market toward the end of the decade and higher oil prices. So toward 2030, there's no peak in demand. But OPEC's problem is non-OPEC supply isn't peaking either. In Canada, certainly the United States, Brazil, and Guyana, and other places. So for the next few years, OPEC has what we call an extended foothills of this next boom cycle. And they have to be careful and judicious and patient with how they return their production to the market. They have to manage the market carefully for the next few years. If they do so, then the world is theirs because we're not investing enough and we're going to tighten toward the end of the decade.
That's interesting. Not enough capital being put into fresh oil production.
Right. That's exactly right. But, you know, everybody sees the collapse in energy investment and oil investment. Where we debate is on demand, right? If demand for oil globally is really going to peak by 2030, as the IEA and many others say, then we don't have a problem. We don't think it's going to peak. We do not see any evidence that policymakers are willing to compel motorists to buy cars they don't want to buy. Even with EVs coming, we don't see a peak in oil demand. And that's the big difference, because if we don't see a peak in oil demand, demand for oil grows around 1% a year. We're going to find out that come 2028, 2029, we're not investing enough and we're going to be short. And the price will have to do the market balancing by rising.
But aren't electric cars a lot better in some ways? I mean, they're cheaper, according to their advocates anyway, on a life cycle basis. They're quiet. I have heard some people say, if you go electric, you never go back. So isn't the momentum behind EVs right now?
There is momentum, and I've driven them before. I've had a hybrid for a long time, but I've driven them. They're a blast. They are cool. However, they're more expensive than conventional cars. They're harder to find charging stations than tanking stations. They lose about half of their range often in cold weather, which you in Canada are well familiar with. And so they have some obstacles, and governments are stepping back from subsidies and so forth. We're more interested in making sure that the EVs are made in North America or in friendly countries than a quick EV transition with Chinese kit. So you have these headwinds. Look, I want to say again, Rapidan assumed very aggressive EV penetration scenarios. If consumers love these things, they will buy them. I mean, that's what happened the last time we transitioned from 5 millennia of horses and buggies, right? From Moses to, the 1800s, you had a horse was as fast as you could go. Well, the reason we transitioned to cars was not a peak horse policy. It was we had innovated and figured out a better way to transport yourself. And so if that's about to happen, consumers will flock to these things. But even then, Andy, we don't see demand peaking. There's not enough efficiency gains in the conventional car fleet. You have petrochemical use growing, a developed world growing. We still think demand grows well past 2030.
What's your number? Did you say 2033 could be the peak? I know it's really, there's so many factors here.
Yeah, no. So our analysis just went out to 2033, and we don't see any peak by then, and we don't see it any time soon after that. I think, you're probably looking at 2040, if not beyond, in an aggressive EV penetration scenario before we would see total oil demand peak. And that's very different than what the IEA has started forecasting in the last few years and what many other forecasters have. The big debate is about demand going forward, not so much supply, in my view.
Is it a fundamental tenet of U.S. policy that gasoline prices must be kept low?
It's not exactly in our Constitution. That's a myth, but it's. I worked for a President Bush 20 years ago, and I'll tell you, few things matter more for any sitting president than the price of gasoline. And we saw when price of gasolines hit record levels in 2022 after Russia invaded Ukraine, the President Biden, changed his tune on keep it in the ground and suddenly discovered the joys of shale production and so forth. So, but they're going the right way for the president right now. They've been falling like a rock since September. They're approaching a $3 a gallon annual average. And you're seeing consumer confidence in the United States improving. That's a big reason. Inflation improving. Folks talking about the Fed being done and even cutting rates. A lot of that is due to oil. So for the moment, gasoline prices are going in the right direction for President Biden.